So enjoy.
Thanks, Gabby. Yeah, Jason here, one of the co-founders of Cake. I'm originally an accountant, and then I was a CFO, and for the last 5 years, I've been working in the tech space. Originally, just when Cake was born, I was working more so in capital raising, and that's when we realised what a difficult space that is for founders to operate in. And now we've built Cake up to a situation where we're the market leader in Australia. We're operating in the UK, India, Singapore, and the US, and it's our mission to make startup equity simple and fast. We've got some really great solutions, software solutions, and we regularly do these education sessions on ESOPs and raising and cap tables and stuff like that. So excited to be here today. We've done a lot of these over the years, and so we've got a lot to share, and excited to be doing this today with Geraint and SprintLaw. Sprint, one of our best partners, awesome firm, so good with startups, and we're excited to be working with them both in Australia and the UK. So yeah, want to say good day, Geraint?
Yeah, hi. I'd love to say good day. I've been working with SprintLaw for a while now, since last year, since they started working in the UK after being established in Australia, and we work a lot with startups, so there's a lot of synergy between Cake and SprintLaw. And most recently, I've been working on the EMI Share Option offering that Cake is rolling out in the UK, and helping out with that. And in that capacity, I'm here today to provide some extra technical information regarding the UK market.
Awesome. So yeah, so we're going to cover, what is the overall sort of employee option thing look like? What are the benefits for the startup, the benefits for the employee, some tax information as well. Obviously, we don't want to make any mistakes when it comes to tax. Some really useful tips about how to set it up, and then also a little bit at the end about how Cake and Sprint actually go about helping startups as well. So Geraint, you probably want to kick us off and give the people on the call, I guess, a bit of an overview of what it's all about.
Yeah, absolutely, no problem. Just firstly want to apologise. There's a slight mistake on this slide where it says option. We actually mean to say ownership, because we're talking about share ownership. Option is just one of those elements, one of those ways that you can get ownership as an employee of a company. So a share ownership plan, an employee share ownership plan, essentially allows employers to remunerate their employees with an interest in the company in the form of shares or options, which are subject to certain limitations and rules, depending on the jurisdiction, depending on what's in the company's constitution, etc. And these benefits are usually in addition to salary as an incentive, but they're not always in addition to salary. And I think it's important to stress here that whilst we work with companies that are a bit further along the road, we also work with companies that are right at the founding stage, that don't have any funding or capital, but they have a great idea, and they attract people to work for them because they're interested in the idea and they're interested in the possibility of how that idea could develop. And in those situations, people might be working on a purely sweat equity basis, which I'm sure many of you have heard of before. And instead, in these situations, they won't be receiving any salary. They'll instead be receiving either shares directly or the promise of shares in the future, which is subject to limitations like vesting periods with a cliff, or key performance indicators like annual recurring revenue, specified project completion in some cases, or the supply of deliverables. So there's a wide range of employee share ownership plans. Today we'll be focusing on the EMI option scheme, which is applicable in the UK only, but I just wanted to lay out a bit of groundwork early on.
Awesome, mate, thanks. And the EMI scheme is by far the most popular scheme, would you say, with startups? From what we've seen, I think that's the case.
I would say that EMI schemes are potentially the most advantageous for employees in the UK, but equally they're quite hard to get right, and because they're so tax advantageous, there are a number of criteria that you have to fulfill and keep fulfilling on an ongoing basis.
Awesome. Look forward to covering that with you a little bit later as well. Cool. So look a little bit more about setting up, an EMI or a share ownership plan. It's really important to understand that there's two components to setting these up in a way that's going to work well. So the technical part is obviously very important, making sure that the legal aspects are correct, the valuation is set up correctly. Any documents that need to be signed by the company, by the shareholders to implement the scheme are signed, and that the way the vesting and exercising is done, and the tax implications and how the plan fits into your cap table. So they really are quite a big thing to implement. They're not something to be taken lightly. Working with experts like Sprint and using software like Kate does take a lot of the burden from you, because we've systemized and standardized a lot of things, but it is something, there's quite a bit to it. And quite often startups will get so bogged down in the technical part that they won't have the time, or they won't take the effort to do the people part, and that can really come back to bite you. So the reason that the scheme goes into place is to really help engage and retain and attract great team members. And if you really only do the technical part and you don't include things like, building a culture around the scheme and, really caring about sharing in the success of the company with the team, putting really good change management, or, at least communicating really clearly with, your team members about what it is and why it is and what the benefits are, and what can happen for them financially down the track, you're not going to be getting the benefit of the scheme. So it is really important to understand, both those parts when you're setting it up. Now, we kind of work in these early stages a lot. I'm sure there'll be a lot of people on the call that are, in this stage. It is, good to know how this can work mechanically. So we would normally advise setting up a scheme on day one and getting into it as early as possible. Geraint mentioned things like sweat equity. So making sure that you have schemes in place to help with advisors, to help with those first hires when they're coming in. You may not be able to, pay full salary in the beginning because you're either bootstrapping or you've raised a really small first round and you're trying to maximize the amount of cash that you have. So get the scheme in place straight away, and then, start using it with those first people. Through your pre-seed and seed round, you're probably still using that same 10% allocation. It should make it through that phase. Again, still for advisors, and your team might be growing a little bit through this time. Once you get to around your Series A, or perhaps, towards your pre-Series A or something like that, around that stage, quite often your 10% will run out and you need to top it up or put a new scheme in place. So just be aware that does happen. And then, you might be allocating some of that to some really senior and high-powered people that are coming in, and they can really need quite a bit of equity to come and join the team. You might be continuing to build advisory boards at that time, and you're really scaling up your team there. At Series A, you're quite often going from 20 to 50 people plus. So you need to make sure that you've got some options allocated for that. So I think we talked a little bit about some of these use cases. It's not normal for the founders to be included. They would normally have their founder equity. Sometimes, as you get through the rounds around Series A, additional options can start to go to founders, but it's quite often in a separate scheme. Your advisory board members, it's quite normal for them to take equity under these schemes. Founder Institute has some great frameworks for that. It can be anywhere in the vicinity of 0.5 to 1.5%, depending on how valuable those advisors are and what time frame you're offering them. First 5 employees for sure. You really want to attract and engage and retain those people. There's a lot of IP, there's a lot of value in those core staff in the beginning, and you want to make sure that they're incentivized to stay. So definitely allocating a good amount to them. Then as you scale as well, for sure, all those first 20, 50 employees are all going to want options these days. And you can calculate how much they should get based on their salary. There's some more traditional, I guess, and more, corporatized ways of calculating that as you get further along. Sometimes contractors can be there, and we've talked a bit about sweat equity as well. So it is costly to run one of these schemes. It costs you in accounting and legal fees up front and ongoing. Something like Cake to manage it. There's the internal cost of administrating it, and a proportion of your equity is going out the door. 10, 15%, 20% of the equity over the first few years is going out the door, right? So this is a really meaningful cost. There needs to be a great benefit for the company, which there is. So I've broken this down into 4 sections, and Geraint, feel free to jump in anytime. But the first big benefit here is around attracting staff. So I'm sure any founders on the call will know it's an incredibly competitive market hiring right now. So you need to know, what the base salary is that people are expecting and that they're being offered, and what the option plan, what they're being offered in the equity plan as well. Understand that there's different amount of options being offered to, say, technical development staff versus administration staff at different levels of seniority can require larger amounts of equity as well. So just be aware how that goes together. It's going to help you attract great people, and be really clear when you're making the offer as well. Explain, there's base, plus bonus if it is there, plus the options on top. Talk about the size of the overall package. It puts your offer in the best light against, a similar offer, or perhaps a similar offer that isn't communicated as well. So it can be a real strength if you can communicate that well. Do talk about the company valuation as well, because if you're able to raise each year at a greater valuation, then the employee gets more and more benefit every year while that happens. So it's important that you talk about that with employees, especially if they're switching over from corporate or they're coming from an environment where they're not used to this type of thing, because it can be a really attractive way to get good staff on board. So with regard to retention.
Sorry, could I just go back a slide?
Yeah, yep.
Sorry,
Sure.
I just wanted to hop in on the 4th bullet point here about company valuation, and just add that it's also really important to talk about company valuation, particularly in relation to EMI schemes, so that the employees really understand what their potential windfall is, and also what their potential tax liability is once they exercise their rights to the option. And so, yeah, it's very important to be incredibly clear about that, so that people really understand how much benefit they're going to get at the end of the period.
Yeah, I couldn't agree more. The employees are quite often really unsure about the whole thing. And so the more clear you can be, the better for you. And you're under an obligation quite often to share all those facts as well. So you really do need to make sure you do that. Okay, so one of the worst things I think that can happen is you have a really key team member come on and they spend a year and they go off to Amazon or Google or whatever. We do not want that happening. We want to be able to keep our people as long as we can. So 3 or 4 year vesting period, which means that, if it's say 4 years, each year they're going to get a quarter of their reward, right, of their equity. So it's really attractive for them to stay, especially if the valuation of the company is going up every year or two. It becomes really quite valuable to them, and it keeps them at the company longer. The 6 or 12 month cliff is also a very, very smart thing to do. So when they start, for the first 6 months or the first 12 months, they don't actually really earn any, they don't invest any during that period. Just especially if you don't know them very well, it's a smart thing to do. You can have milestone-based vesting as well. So you can set specific KPIs that say, look, if you hit a certain sales target, if you open up a certain country, if the whole company hits a certain ARR target or something like that, then the milestone is hit. So you can, try and retain your key people until you hit your big milestones. We started to see some backloaded options. So you might have 10% in year one, and then 20, and then 30, and then 40. So again, it encourages the team members to stay with the company longer into those later years. Also look at reloading. So if you have, say, a 3-year vesting period and an employee is in that 3rd year, get on the front foot and let them know if you're going to top up their equity again for another 3-year period, just to take their mind off looking elsewhere. Look, this is a really valuable lever for employee retention for sure.
Sorry, just go back one more time again.
Please.
Yeah, there's a super important point here in relation to enterprise management investment schemes, the EMI schemes. So it comes down to drafting, and also when you need legal advice. So the best way that I can describe it is essentially it all comes down to value. And before you enter into an EMI scheme, it's worth having your shares valued. We'll talk a bit later about how HMRC can help with that. But essentially, one of the things that affects the value are things like vesting, cliffs, milestones, etc., because they are conditions, right, before you can actually get the shares. And it is a requirement under the law that these are made very clear to the option holder at the outset, and they should be included in the Articles of Association. So, for example, if we're talking about a 3 or 4 year vesting period, and if you don't, or a 12-month cliff, even better example. So you don't get any shares in the first, you don't vest any option shares in the first 12 months. That needs to be included in the articles. You need to be made aware of it. It needs to be clearly outlined in your offer letter and should be reflected in the value of the shares when they're being offered in the scheme. So that's something that's quite unique to the UK market and EMI options. And one of the things that is hard for companies, because it actually requires bespoke articles of association that articulate these milestones or restrictions. So I just wanted to make that clear to everyone.
That's great, mate. And we've got a question from Bavin. Is it for the company to advise on the tax risks on options and their exercising? It sounds like the company does have some obligation, but would there also be an obligation on the employee side to get tax advice, or how does that work, Geraint?
I would say both. It's definitely something that the employees should be made aware of by the company, and I think Cake, you guys do this very well in your package, because you have an information sheet which clearly lays out all of the tax risks and benefits. But again, we are talking about a complex area here, and I would definitely always recommend getting advice from an accountant.
Yeah, we always say the same thing. You know, it's really good to to simplify it and understand it as best you can, but having legal and tax support is really smart. It's a tricky area. Cool. All right, so we'll keep trucking along. We'll go to incentivization. One thing you can do is just, and look, it might sound simple, but it isn't always done this way. Incentivize the employee to align with the company goals. Perhaps consider milestone based, as I said before. So therefore, the goals of the plan are directly aligned to the goals of the company. We talked about backloading. That's where more options happen at the back end. It sounds like, Geraint, they'll need to be obviously highlighted, in the articles and the offer letter. And yeah, I think just really making sure that the plan, the option plan, is really aligned with the company. It also doesn't hurt to talk about what the possible dividend and exit opportunities are. I think at the end of the day, this is a financial instrument, and while there are some great cultural benefits to it, if you can directly connect an upfront offer letter with a potential dividend or a potential exit, while of course not acting unethically and overpromising things or anything like that, but if you can give some indication of the goals of the company and potential successes, not a bad way to really help them understand what's really going on. And this is one of the more powerful ones that we love. This one at Cake. It's really about building an ownership of a culture of ownership within the company and the team. So how you can do that? Things like giving regular updates. So at Cake, at our monthly all hands, we always have an update for the team, like an investor update. How are we going versus our milestones? When do we think we'll raise again? What are the conditions like? What sort of valuation target are we going for? You don't have to do that, but it's a really nice discussion to be having. Share the value of the options with the team. So you can share them on day one, and then you can regularly give them a method to calculate the value of the options. So perhaps after every round where your shares are repriced, you can help the employees understand what the options are worth and whether there's been a gain or loss. I'm sure there's really specific ways that you need to do that from a tax perspective. But it's important because otherwise they can perhaps just, again, fall into the back of their mind. And there's a lot of value from the company going out into this scheme. So you want to make sure you're regularly, keeping the scheme fresh and front of mind in the culture of your team. I guess that ties into the wealth creation and equity as a team. Many startups these days will go up into the $100 or $200 million plus valuation range. The first 10 or 20 employees in that circumstance can end up with a really life-changing event. Even the first 50 employees, it's a really material financial event. So look, it is something that's exciting and worthwhile pursuing and talking about as a team, especially with those people that may not understand that, and then you get more value out of it as a company. And then again, talking about secondaries. So if and when and how there can be a secondary. So, new investors are always looking for access to good startups to invest into, and secondaries are becoming more and more common. So the founders and the early team members, under certain specific rules, of course, in each country, they needed to be abided by, and the articles of the company itself as well, normally approved by the shareholders and the board, but organize them in a way that helps the company, but also incentivizes the team and builds that culture. All right, so I hope you agree that it's good for the startup, but like anything, it needs to work on both sides. So let's have a bit of a chat about the employee side. Geraint, you want to kick us off, mate?
Yeah, no problem. So I'm going to focus on some of the tax advantages in a second, but I'm also going to echo some of the comments from Jace as well, because I think it's important. Because apart from the tax advantages associated with approved employee share ownership schemes, the employees can see the value of their contributions compound as the company grows, which is a really rewarding thing to see. It really is a goal to work towards, a financial incentive. And in addition, where the employee is granted shares, actual ownership, or if they're granted options, the chance to become an owner of shares, the employee interests are far more likely to align with the shareholders as they feel part of the company. The last thing I wanted to say, because this is something that I see in my working life, is that there are a lot of people that have earned decent money already, perhaps, but they want to work on a new idea, something exciting, but they're not going to work for free, right? And it gives startups that have that exciting idea the opportunity to attract that talent with packages that might be, they're not front-loaded packages because they're not huge salaries, but the options that they can give them, or the share option schemes that they can involve them in, are enough later on, which combined with the tax benefits make them quite a lucrative opportunity anyway. And I think that's one of the reasons that there are these incentivization schemes, why the government approves them. It's to ensure that entrepreneurship is rewarded, and to ensure growth in various sectors. So that's part one. And now we're going to get on to part two, which is probably a little bit more dry, but I want to give you a brief outline of some of the schemes available. So the magic piece of legislation is the Income Tax, Earnings and Pensions Act 2003. And in that act, you have a few different types of employee share ownership plans. So the first I'm going to talk about is a SIP, share incentive plan. And there are four ways actually where you can benefit from a SIP. One is you can purchase partnership shares from employees, and the way that this is tax efficient in the SIP, all of it is from pre-tax earnings. So it's kind of like when you get your pension coming out of your pre-tax, it's the same kind of thing. So you can buy partnership shares up to £1,800 per year. On top of that, you can match those shares, so doubling that up to £3,600. You can also ask for free shares, which are all of these are rewarded without payment, and that's matched to corporate performance. So similar to the kind of milestones we were talking about before, you can award up to £3,600 per tax year in accordance with corporate performance. And then the last part of this, which I think is quite neat actually, is the dividend shares. So where this obviously only works in later stage companies where dividends are being given out. We all know that startups aren't giving out dividends anytime soon. So this is a bit further down the road. But the dividend shares allow you to use all the money that you get from those shares to buy more shares. Essentially, there's no limit on that. And then once you've had them for 5 years and you sell them, there'll be no capital gains tax payable. So that's quite a decent benefit. I just also wanted to highlight, as I did earlier, that this is not an option plan. This is one of the share plans. This is a direct share ownership plan. So you're buying shares directly, not an option to buy shares. All of the rest of the plans we're going to talk about are option plans, just to be clear. So the next one is the save as you earn option. And this entitles the employee to buy a certain number of shares at a future date at a fixed price, which may be at a discount of up to 20%. That's the limit of the market value of the shares at the time that the option was granted. The shares may only be bought using amounts which the employee has saved under a savings arrangement. So essentially, under this scheme, the company has an agreement with a bank or a building society, and your savings go into that building society to buy the shares at the agreed price at a later date. You can also put in tax-free bonuses to buy shares as well on top of that. And the limit from deductions of the employee salary, which is also before your pre-tax earnings, is £500 a month. This is not as good because if you sell the shares, CGT may be payable. So those are two of the other plans that are available under the Act. And now I think we're going to focus on the plan that we've been talking about most today, which is the EMI options plan, which are granted following ratification from HMRC. So they have to approve the plan, and that's where you need help really from Cake, from lawyers and accountants to get that plan approved and to make sure that everyone's on the same page and everyone's on board. The notification must be sent to HMRC within 92 days of setting up the plan, and provided that the plan has not been disqualified, the employee can exercise their options. So the disqualifying events are kind of important here, and I'll go into a bit more detail about the details of the plan and the criteria that need to be met to ensure that the plan isn't disqualified by HMRC later down the line.
Awesome, thanks, mate. Heaps of benefits on the employee side. Just a couple of things to add there. I guess this is just a little bit more around, employee wellbeing and culture. Study here showing, what an employee perceives as, valuable to them. So financial payoff, fair treatment, a sense of community, employee influence on management. So these are all things that are provided by these plans, especially if they're done in the right way with the right culture. And, I guess when it all comes down to it, it's largely about sharing in the success of the company with the employees. So with this scheme in place, when the company, goes on to become super successful, they're able to participate and share in that success, which is largely off the back of their hard work, especially when you're starting off in the very early stages and you've got your first 10, 20 employees. If you do manage to go extremely well and end up with hundreds of employees and have an exit, obviously you want those people to benefit from that. All right, so we have covered a bit of tax along the way, and I think it's been great, to tackle some tax questions as we've been going through. Geraint, I guess, were there any further tax? I think you alluded to a couple more tax issues. What do you think we should tackle here, mate?
Yeah, so I think we're onto the slide now where we can talk about the main benefit of the EMI scheme. First of all, when the EMI scheme is set up and the EMI option is granted to the option holder, and also when the option holder exercises the option, no income tax or national insurance contributions are payable. So that's a big benefit. I need to caveat that by saying that it's provided that the exercise price is less than the market value of the shares on grant. And usually you try and ensure that these marry up, these two figures. If not, the difference between those two prices, so say you originally got it for £1 and then it was £2, you would pay tax and NICs on the £1 difference. Then when it comes to selling the options, capital gains tax is payable, but the capital gains tax rate for most people, if you're under 1 million of lifetime gains, will only be 10%. So that makes it pretty tax efficient when you come to sell the shares. And when we compare it to SIPs, for example, where you're only getting £3,600, it's a huge benefit because per employee, you can grant up to £250,000 in EMI options. And there is a limit of £3 million for the whole company. So you can see how potentially this is a much more lucrative option than the SIP option for an employee. So I think before I mentioned that there were some kind of dry qualifications. So I'm not going to go into too much detail here, and you will need legal assistance to determine where you fall within these criteria, but I'm just going to go through them briefly. So for first of all, the companies, we're talking about SMEs and startups. The EMI schemes are aimed at SMEs and startups. The gross assets of the company can be no more than 30 million, and the company must be independent as well. So it can't be a subsidiary of another company or under the control of another company. The other qualification is the company must carry out a qualifying trade, and this is where you might need some legal assistance, but I'm just going to mention a couple of things that are not qualifying trades in case you were getting excited. One of them is property development and property businesses, leasing of property and other assets, and another one is financial trading. So those are out for the EMI scheme. And the company must have less than 250 full-time equivalent employees and have a permanent establishment in the UK. However, it should be noted that even if the company is an overseas company, for example, the UK company is a qualifying subsidiary and it's not an issue in regard to the qualifying trade and has a permanent establishment in the UK, then there could be an exception made there and it could still qualify for EMI. So it's not completely out, but again, need legal advice on that one. In terms of employees, so that's the company. For the employees, those that qualify to be option holders must be working for at least 25 hours per week, or the equivalent of 75% of their working time, or of working time, standard working time, and they must be actual employees. So we did talk a little bit before about advisors and percentages that advisors can get and consultants. That would not apply under the EMI scheme because we're just really talking about employees. So for those types of relationships, different schemes would be more appropriate. The other thing that we should mention is some of the disqualifying events. I mean, we talked about the things here, the criteria. So essentially, if any of those criteria change during the option, then that could be deemed a disqualifying event. So if the employee stops working for the company, disqualifying event. Or if they start to hold a material interest of more than 30% in the company, which is also not permitted as an option holder, that's a disqualifying event. If any of those things happen, the employee needs to be aware that they have happened and that it's an issue, and they still have the opportunity to exercise their option, provided that they do so within 90 days of the disqualifying event occurring. So these are the kinds of things that really help with transparency. So you have, apart from, we talked about a bit about the constitution, what's in the Articles of Association, we'd also have a share option plan, which is kind of like a shareholder agreement or a subscription agreement. And every employee option holder will be signing up to this plan. And in the rules of the plan, it'll state all of these things. So they can always refer to this. This will be their Bible for the option. And they can always refer to that to see if anything has happened that could be a disqualifying event. And the company also has to be very transparent about things that may have occurred to make them the precipitate a disqualifying event on their behalf rather than the employee. So yeah, if that does happen, if there is a disqualifying event, you don't exercise your options within 90 days because you weren't aware, then instead of having an EMI option, you'll have a non-EMI option, which basically means it's a standard option without any of the tax benefits. So it's not the end of the world, but also not great. And we want to make sure that that doesn't happen at any point. So I think the next thing to kind of mention is a bit about process and how to actually register a scheme. You do register it with HMRC, and it's worth getting advanced approval from HMRC as to the valuation of the shares, because first of all, transparency, employees will like that because they'll have an outside independent body, government body, verifying the value that you're purporting to give them, which is great. It's free, which is also great, but there will be some costs involved in the valuation itself because you'll have to submit figures to HMRC, and those should be prepared by an accountant, because we'll be talking about the value of the shares based on restrictions, et cetera, which is something I mentioned earlier. Gets quite complicated, definitely something for an accountant to help with. And on the legal side, the documents are really where you need help. So the option agreement or option letter, where the employee is notified of their option and any associated conditions, and then the rules, the Bible we just talked about. So I think that covers most of what you would need to know in terms of setting up a scheme. Have you got anything to add, Jace?
No, that's awesome. There's a question here from Bavin again. How do EBT or other benefit trust schemes compare to ESOPs? You following that one, mate? I'm not sure what EBT is. Employee Benefit Trust. Yeah, benefit
employee
trust
benefit
scheme.
trust
Not
scheme.
sure about that.
So this will be, I mean, it's kind of similar. I'm not sure of the exact limits on the EBT, so it's hard to say how it would compare in that regard. But essentially, that's where your options are backed up by a trust. So I guess there's more security in an EBT, but I'm not sure about the tax benefits, so I couldn't compare the two on that basis.
Cool. All right, we'll move on. So, like, you did talk a bit about how to set up, specifically around the lodgement with HMRC. We got into some of the key documents of the scheme. We'll just go over that a little bit now. We've got a couple of sort of illustrations here to help us. This one here, I guess, is a bit for me, I suppose, just to highlight to everyone that there is a lot to do. And as I've said in bold there, you know, your equity is going out the door. You know, so you have to make sure it's working for you. Here's a bit of information that we pulled out recently around cliffs investing. So I think it's important to try and understand the trends when you're putting these things in place. And as Geraint said, you know, the tax implications and the information that you need to share with your team. Also, you know, look around for benchmarks on what's being offered as well. So when you're implementing the scheme, as well as definitely getting your valuation and your tax correct, and getting your legal documents right, think about how much equity different roles would be getting in the market, and how to keep yourself competitive. Here you can see a significant increase from 2018 to 2021. So it's a more competitive market. You can also see tech roles getting quite a bit more than non-tech roles, so it's quite interesting there. Here's a little bit about how to actually calculate, one way to calculate how many options and what percentage of the company they could get. So this one's in dollars. So remuneration of $100,000, an option offer of 20% of their salary would be $20,000. So total remuneration 120. It's a 3-year vesting period. So 3 times 20,000 is 60. And then when you apply that against, say, a 4 million or a 2 million or an 8 million pre-money valuation, you can see there, the percentage of the total equity of the company that this employee is going to receive. So this is, quite an early employee, obviously, because the value of the company is still very small. And I guess you can see how just a basic maths there. And I think for some people that haven't been through this before, it's interesting just to start to understand some of the maths and mechanics of how how you can calculate putting your offer out there, and how it relates to the ownership of the company. So as Geraint was saying before, there is quite a few steps along the way. This isn't all the steps per se, but in the setup phase, you're doing things like making sure you've got the rules set up correctly. So working with a lawyer to make sure that the rules are set up. Quite often, you'll have to get the shareholders to sign off to say that the scheme is viable and it's in place. Make sure you get the right valuation done by your accountant, and there's the lodgement to do with HMRC in that setup phase as well. And then you go into the phase where you're sort of implementing it with your team. So sending the actual offer letter out to the team member. As Geraint said, it details quite a lot of information. It should have the option price, the exercise price, any sort of cliff or vesting information. There'll be some specific tax requirements, and you'll need to provide the plan rules and the shareholders agreement, all that documentation for review. Once that is signed, then the vesting will commence. As the either time-based or milestone-based vesting events occur, I guess vesting is like the point where the options are sort of earned by the employee. After that has happened, the employee has the ability to convert their options to shares, which is called exercising. There's, again, specific rules about how and when and why that should occur, specifically to make sure that tax mistakes aren't made, particularly. And then, there's regular tax reporting to be done as well. So, quite a bit to be done on the technical timeline. Anything you want to add on that one, Geraint?
The only thing I wanted to add is that there is a long stop on the EMIs of 10 years. So this timeline has to be less than that. But that's the only thing I wanted to add.
Perfect. And there's a people timeline as well. So, I always like to highlight, the two sides of this. You do need to get all the financial, legal, and tax aspects correct. But, also think about the people and the culture, and make sure they understand it, they value it, and that the company is getting benefit from it. So, set that up at the company strategy level first, so with the founders and the leadership team. Make sure that you're sending emails out to your team. If you've already got a team and you're setting it up, make sure they understand what it is and why it is. And Cake provides really helpful guides, both for the company and for the employees. And look, even have some meetings with them and let them ask all their questions. You'd be amazed the questions they ask. It's really a complicated thing, and it's hard. I mean, you might go through it all with your lawyer and you might be in the Cake team or whatever, and then you think everything's cool, but then you really can't assume that your team is able to pick the stuff up quickly. So take the time to make sure they understand it, go through all the details, make sure they feel safe, give them time for questions and follow up. Once you feel like that's been done adequately, you do need to keep the vesting up to date. So there does need to be a way to, handle any cliffs. So at the end of the 6-month period, you want to notify your team that the cliffs happened, or whether it's 12 months or if it's monthly or quarterly vesting, you want to be able to keep your team up to date. The Cake system does that automatically, which is super helpful because it can be all over the place. And without a system like Cake, it really does become a dog's breakfast very quickly, and you end up with quite a lot of problems after that. It's really good to connect, the equity plan into, performance updates for both the company and the team members. So just come back to it regularly, make sure they understand, how their performance is going, that the options are vesting, the valuation of the options, and all these things as we talked about earlier. And then, maintain a growth narrative to your team members in the same way as you would investors, to make sure you're maximizing the value of that equity that's going out to your team. So, that's it for the nuts and bolts. I would like to say here that, and we have sort of alluded to that all the way through, it is quite a technical process. There's a lot to do. There's legal, accounting, tax, and administrative steps, and you've got the technical and the people aspects, and it does go on for several years, and it can get out of shape very quickly. So Cake's built a system to help startups have peace of mind throughout the whole process. The wider system handles shares and options and notes and the wide gamut of equity. And we work super well with Sprint. We're huge advocates for making sure you get the right legal advice, throughout this process. Geraint, I don't know would you like to share a little bit about that too, please, mate?
Yeah, absolutely. So I think Cake do an amazing job of simplifying the process so that you understand, so that the layperson can understand what needs to be done. And in theory, it can be quite simple in certain circumstances, but if there are some variations, for example, the company's constitution or the asks for the conditions of the options, then you do need help to adjust the constitution, the articles, etc., to tailor them to ensure that you get the correct valuation and to ensure that you're compliant with the legislation. And yeah, I think with Cake's system and with sometimes a bit of extra legal advice, and in other cases might not be necessary. It's a very straightforward situation. We've got a good system in place to help you out with these plans. The only other thing I just wanted to touch on again was in regards to that question about employee benefit trusts. So I did a little bit of Googling over the last couple of slides, and it seems that the tax and national insurance are payable upon income from employee benefit trusts, in contrast to EMI schemes.
Yeah, that's why the EMI scheme is so popular. Fantastic. Thanks for clearing that up. So we have a special offer. Cake's free for the first 5. So if you're just starting out, Cake's a great system. It's going to streamline and systemize a lot of things. And then you can work with Sprint, to get the thing set up, and then, Cake can manage it ongoing. We're offering a 20% discount on the software as well. And yeah, thanks for joining. We love sharing all we've learned. We do try and simplify it as much as we can, but it's also very technical. So I'm really grateful for Geraint and his technical, content this evening as well. Does anyone have any questions to finish off? I think we might have one more here. We have thank you, no worries. Appreciate the questions as well. I really hope that was helpful. If we haven't got any more questions, that's it from me. So Geraint, anything from you, mate, to sort of finish off with, or that we didn't cover?
No, just that I really enjoyed doing this webinar with you, Jace, and yeah, hope to do one again in the future.
Yeah, absolutely. We're really passionate about employee ownership and helping startups. So yeah, hit us up with any questions, and our email addresses are there. So otherwise, yeah, have a wicked day, and good luck with your startup.
Thanks, everyone.